Okay, guys, welcome to our first training for Kraken Core or Elite, and we're going to talk about the basics. We're going to dive into pretty much what stocks are and what they aren't, as well as the difference between investors and traders. We'll kind of follow along um, from the short blog that I posted to kind of guide me along to make sure I kind of touch on all of it. And if you have any questions, certainly let me know. Each week, we'll touch upon something that's a bit different. We'll try to save enough time to start to really lean into stocks themselves, the charts, and all the rest of it. But you got to have some sort of foundation into what we're doing and what it all means, because if you don't, then uh, it just is not going to help you longer term. You won't, again, have a good base of knowledge. So, what are stocks? I'd imagine you guys all know that we'll eventually watch this even later. Stocks are an investment vehicle, if you will, that allows you to buy a security um, of a company that represents ownership of in the company, and that ownership can then be sold. So you buy, if this represents a share of stock, a certificate, you buy X amount of shares. You believe the value when you bought it was $10. You know that a minute later, 5 minutes later, a day later, however long later, someone else may come along and believe that this stock is worth $12 a share. And then you make 20% on your money. And after you have sold it, less any commissions or anything. So stocks represent ownership in a company. There are different classes of shares from Class A to, I believe, Class D. And there's some other sort of preferred shares. So there's some other classes there. We are uh, a retail shareholders. We buy stocks that trade on exchanges. The key exchanges, or the most common exchanges or well-known exchanges, are the NASDAQ, um, as well as the New York Stock Exchange. And then you have, a number of indexes like the NASDAQ Composite Index, which has, say, it's the NASDAQ 100, then it has 100 of the NASDAQ stocks in this particular index. You also have heard, of course, of the Dow Jones Industrial Average, or that particular index that shows 30 of the more the larger companies that represent the Dow as a whole. Um, you have regional exchanges like the Philadelphia Stock Exchange, the Chicago Exchange, and then you have, you know, what's called the over-the-counter bulletin, the over-counter exchange. Really, it's where a number of very small cap penny sort of stocks, if you will, trade, and it is less regulated. So when you're moving money, especially when you're new, you ideally want to have the majority of your money in safer, bigger names while you're learning. I made a lot of money trading stocks that were very aggressive. And, I took my balance, as you guys all know, from $5,000 to about $2.4 million in about a year. Um, Certainly making a lot of money is very, very possible, but if you don't do it the right way, you're just going to blow through your account, and that won't be good for you because you'll have wasted your time and you'll have wasted money. Um, Jaden, you're on the call. Have I ever showed you the money?
Oh, sir.
No? Okay. Well, let me just show it to you quickly, just so you can see it. Um, it's not a function of any sort of bragging thing at all. It's a function of a lot of times you just simply have to see the money because seeing is believing. Because, a lot of people will tell you a lot of things and they don't back it up or they have very little clue into what they're doing. So we'll just take a quick peek of that for you guys who are watching this video later, so I don't have to repeat myself. You can just kind of watch it. So are you seeing my face here, Jaden?
Yes, sir.
Okay. So this video, it just is me recapping that Charles Schwab bought TD Ameritrade. TD Ameritrade had Thinkorswim. It was a real popular software that I still used, but now Charles Schwab owns it. And it was a trading platform, and they wanted the customers as well as that platform, so they bought it. And so they weren't moving the chart balance over. So they said, if you want a copy of it, well, you better make a copy because it's going to go away at a certain date. And because I coach, I said, well, let me just make a copy of it so that folks can have a chance to see what's possible. So you see on here TD Ameritrade right there. You see my name, Eugene Brown, Brown Genesis. Excuse me. And you see TD Ameritrade, my account. And what you're going to see is I took $477. I'll just let it play for a sec. And I added about $4,500 to it. See balance history. And I had about a total of $5,000. And I grew that balance during COVID from that amount to almost $2.4 million. You see, it's March 2020. March 17th to be in fact. Yeah, right. Somewhere there, 477, right there. Yep. So I'm going to fast forward it a bit. You'll see in 6 months, I grew my balance to 299,000. And then I lost money. My balance went all the way back down to, can't really get it there. Let's see here, to about $60,000. Right around there. And so as you guys are watching, you're like, wow, went from 5 to almost 300, so 60 times the money in 6 months. And then you turned around and gave up $240,000 later. So if you think about it, Jaden, I know you're on here. It was at 299 September the 1st. By November, so you said September the 1st, by November something, September, so all of September, October, and then into November. So in about 2.5 months, I ended up losing $240,000. I had given a whole lot of it back, right? In that moment, what I want to impress upon you guys is I could have quit right there, held my head high, had $5,000, ended up taking the balance to 60,000 if I had gotten out then. But I didn't quit. And what I did was I made the necessary adjustments. Snook, you on here? I think Snook is coming on.
Yeah, I'm here.
Okay, brother. Just going over showing the money. There's another young man that's on here. Initially, it's just the two of you guys, and don't worry, we're going to be growing. So, it's a new group. So I could have quit right here, you guys, when I went from 300,000 back down to around 60, 2.5 months later, but I didn't. And so what I did was I took a pause, got myself together, rethought how I was doing things, and then look at the date, November the 11th. And I think it's kind of cool to watch how quickly money can grow. November the 11th to December the 7th. So really a month. We went from 65,000 to almost 700,000. So $635,000 up in a month. Some people want $635,000 in a lifetime. So you do that in a month. And so that comes from, you guys, being really aggressive and starting to understand the type of aggressive names I needed to be in for how the market was doing what it was doing at the time. Take 700,000, you back all the way back down to low fours, so you end up losing 200 plus $1,000 in no time flat. And then you keep retooling and then you kind of go up from there. And Snook knows the rest of the story. We went up to, I'll just fast forward it. Here's where we made $1 million in a month, $500,000 a month later, we were at 1.5. And then we just kept going up into right there, 2.370. So about $2.4 million in just under a year. This dip right here, Jaden, is me taking out more than $1 million, paying taxes, buying a brand new home, and all the rest of the stuff. So I did want to share that with you. And for the folks who watch the video later, I'll probably label this video because it's the first one, like training number 1 or whatever. So what we were going over, Snook, was a reminder of what stocks were. You already know it's just you buy stock to be able to sell it ideally at a higher share price. You could also buy stocks believing and investing for it to go down. It's called going short. When you go long, you believe the stock's going to go up, but you can also go short, which we won't get into yet. If the stock price drops, you eventually return the stock to where you borrowed it from and you profit from the difference. It's just the reverse of going long. So again, stocks represent ownership. Stocks can be sold in a tax sheltered account. Stocks can be sold in a taxable account. When a company is a publicly traded company, their responsibility, their allegiance is to shareholders. And if there's something they need to do, they typically satisfy the debt holders first. Like if they had borrowed money from somebody, that's they need to satisfy that, especially if the company was going under or there was a problem. Then because you're a shareholder or part owner of the company, your interest will eventually become last, especially if there's a liquidation or there's a problem. But while the company's in good standing, everything is about shareholders. It's really just about shareholders. And you'll see that really governs their decisions in just about everything that they do, the folks who own the company. What else? Let's take a peek at some of the other notes on there. Let's see here. I said that I was going through some of the notes that I put into the system under your private Facebook group, where I can get out of this, or I can let's see here. I'll take your questions here in a second. Facebook, where I can kind of guide myself along. So do you see Kraken stock trading community? You guys?
Yeah, I see it on the screen. Yeah.
Okay. I just want to make sure. Let me go back to it. All right. So in your group, I was telling Jaden, bookmark this group. You can come up here and add a bookmark on your laptop or bookmark it on the phone, or just save the link that I emailed you, because that's going to be the link we're going to use every week. So you don't have to come in here, but if you want to access the video, because it's going to be right in here, and all the training, everything is going to be in this group. So let's see here. So in this group is where you're going to find your links as well, the videos and everything else. So when I look at what we're going over, I just want to take a quick peek. So talked a little bit about what the stock market is, why do companies sell stock, to hire more employees, they build new locations, they're raising money, they create new products, they pay off debt, they expand into new markets. You guys should all be familiar with that. Where does all the trading happen? I talked about this already before you jumped on, Snook, the New York Stock Exchange and the NASDAQ exchange. And then I talked a little bit about indexes like the Dow Jones or the NASDAQ Composite Index. There are a lot of indexes. Indexes are just a basket of stocks that represent whatever they represent. It could be a technology index, a retail index. We have nothing but retail names. So it's an index. It's a group of stocks that represent whatever their thing is. How do prices go up and down? Obviously, company performance. If Walmart has a blowout quarter after Christmas and they exceed analyst expectations, then the stock will tend to go up. News and earnings reports, which I just talked about, the overall economy. And then there's the fear and greed aspect to it. People bid up a stock or bid it down, if you will, sell it down if there's a lot of fear and greed in the marketplace. We just had the U.S. government go into Venezuela and take their president and bring him over here to New York. That event has moved the oil markets. There's lots of stuff that will move the markets. And so if it's not fear or greed, it's usually one of those two things that can sometimes really move a market. Supply and demand, if there's a whole lot of supply, then the stock will tend not to really move much. But if there's a whole lot of demand for a stock, the stock can really take off. So let's take a quick peek at we'll take a peek at, say, Chevron. Let me share here. Am I sharing my screen yet?
Not yet.
Not yet. Let's do it.
Look at what we're working on for WSB tonight. A deadly shooting outside of a convenience store in DeKalb County. Just window we're speaking on now.
I can hear your TV. Let's see here. Chevron.
For those who knew the victor, sharing an update on where the search stands.
Still. There we go. So Chevron, you guys can see the screen?
Mm-hmm.
Okay. Chevron is obviously Chevron, and even certainly Jaden knows that's a huge oil company conglomerate. And if we look at a monthly chart on Chevron, we can see that Chevron was in a downtrend that kind of connected like so. This area, this area, these areas, this area, the whole way down. Kind of broke through that resistance a bit in here. Then clearly, we talked about fear and greed and supply and demand. Something not so great happened in this month. Either earnings were horrible. This is Trump month. You know how I know? Here are the dates. There's the date, the open, the high, the low, and the close. This month is April. April of 2025. That was when Trump initially was talking about, tariffs on the Chinese and everybody else. And then he eventually reversed course. And then that reversal of course took the stocks all the way back up in a hurry. So this was April. And if they were putting, the Chinese, the Russians, and everybody else, if they were also putting tariffs on maybe what Chevron was doing, Chevron's a global company, so I'm sure they were getting affected by tariffs in different marketplaces around the world. And then that had an effect on their stock and they tanked it. But then it recovered after Trump said, oh, we're not going to, lean into tariffs, but so much. So, fear and greed or an event in the marketplace can produce something like this. Recovery can produce something like this 4 months later. But we're still, if we connect this area and then the bigger area up top, you can see that there's some overhead resistance here and here, and we extend that line out. And guess what happened this month? Yesterday we were up, we pushed up towards here, but we still haven't closed through the resistance, and we'll talk about that at another date. So Chevron is still in this downtrend, and it just looks something like, in these three general areas, connecting this, and connecting the top. It's still not out of its own way. And Chevron, although it was up yesterday, it was down 4.5% today. So fear and greed, fear and greed. So let's go back to the lesson here. All right. So we talked about more people buy versus sell. How do people make money in the stock market? Talked about that. Price growth. You buy low, you sell higher. They also issue dividends. A dividend is just a payment. If you own whatever, 1,000 shares of Microsoft's stock, twice a year they may say, for the people who own my stock as of this date, they're going to be issued a dividend. So however many shares you have, they may say, I'm going to give you $3 for every share that you have as a dividend, as a payment, as a thank you, as a sweetener. And then for the folks who own that stock by the close of this date, they're going to get that dividend issued to them. And a lot of times when they know a dividend's coming up, people in the marketplace, they may tend to go ahead and buy the stock to get the dividend. Does that make sense? Let's see here. The stock market isn't gambling when you approach it with education, strategy, patience, and risk management. All right, questions on that first part? Jaden, what do you got? What jumps out at you? Everything makes sense? You're familiar with it all?
What was the bottom part where you scrolled from that you just said
What do you mean
above
we scrolled from?
where like dividends?
Oh, where do they come from?
Yeah.
They come from the company itself. Again, if you own Walmart and you own however many shares, we'll use 1,000 shares as the example, the dividends come from the money that the company already has. And so, to entice people to buy their shares and to hold their shares, they may issue a dividend. It's kind of a thank you. It's more of a tax thing, I think, where they get rid of some money in the form of a dividend, so they maybe pay less in taxes. It's also as a bit of a thank you to their shareholders. And again, sometimes if you, me, and Snook and everybody else knows that Walmart's going to issue a dividend, we might say, they usually issue a quarterly dividend. I want to make sure I own their stock by this date every quarter so I can take advantage of that free money. And usually sometimes when there's going to be a dividend issued, the stock starts to get bought because people want to get the dividend, and it makes the stock price go up. And so when the stock price goes up, if the stock went from 50 to 55 ahead of the dividend, well, that may mean a lot of money for the company itself. And that $5, that extra 10%, well, what if it was whatever, we'll call it $1 billion company as it relates to stock price, and their stock went from $1 billion valuation to up 10% to 1,100 million. Well, hell, they can take part of that 100 million and issue part of the dividends to their shareholders. They're just kind of taking it from the money that bumps it up anyway. So there's a lot of ways to do it. So a dividend, it's just a sweetener. It's like someone says, hey, Jaden, if you work overtime, I'm going to pay you time and a half for the folks who sign up. And the folks who sign up for overtime, they're going to get paid time and a half. Plus, we're going to give them some gift cards. It's just a sweetener is all.
All right. So dividends pretty much an incentive, basically.
Yes, it's an incentive for you to buy their stock and hold their stock as of a particular, what's called a record date. The stockholders of record, on the books, the record date today is the stockholders as of the record date of January the 6th. If they own that stock at the close of business today, in another 57 minutes when the market closes, they're going to be they're on the record. I see Snook's name, I see Jaden's name. It's going to they'll send it down to the brokerage firms, TD Ameritrade, if they were in business, not Rocket Mortgage, Robinhood, and all the rest of them. They know in the system this dividend's going to get issued out, and then they may say the dividend will be paid on January the 10th, and it'll just get paid automatically. Yes. All right, so we know why people buy stocks. We know what companies use the money from the stocks for. What we don't know really is how they how they really come up with some of these numbers. What happens is if the three of us, we have a company called whatever, 123 Media, and we take our company public, you, me, and Jaden may decide that we want to issue to the public 5 million shares. So we have an initial public offering where the public can buy all of these 5 million shares. But we're going to hold 95 million shares in our coffers. So the public is only really buying 5 million shares of what we really have or that we can continue to issue. It's like having a piggy bank and we tell the SEC, the Securities Exchange Commission, that, hey, we've started a new company, we're going public. Our authorized shares, how many we're authorized to have for our company, is 100 million shares. The shares that are outstanding, that are kind of out there between what the three of us own and some of the mutual fund companies, and some of the public, is half of that, 50 million shares. And then what's actually being traded on the market is called the float. So you have authorized shares. What are we authorized to put out there? You have the shares that are actually outstanding. What do we got out there with mutual funds, investment money managers, et cetera? And the shares that are actually being traded, because of the 50 million shares that are out there, the three of us, we've held back 10 million shares. So what's actually being traded is 40 million shares. Does that make sense? So it's like, what can we actually do? What's really out there and what's really being traded? Okay. And you'll maybe hear that a couple of times. You're like, oh yeah, I remember that. Um, and so that's kind of that. So, the market's been around for many, 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 many years. They call it Wall Street. There used to be a wall and they used to run bulls and all kind of crazy mess used to happen back in that area. A long, long time ago. That's where you get the bulls and the bears, where you see the bulls and the bears behind me. There's a thing with the bulls on Wall Street. Bulls are people who are bullish. They believe the stock market's going to go up. They like a lot of what's going on in the economy. They're bullish. Bearish, they're, like you think about someone hibernating for winter. They don't like what's going on. They believe the stock market's going to go down. So there's always this fight between the bulls and the bears. And so one of the sayings is bulls make money, bears make money, because I told you could go short, and sheep or pigs get slaughtered. People who just don't get it. Sheep, they're the folks who don't do their homework. They'll listen to anything. I tell you, I send you out a marketing piece that says ABC stock is going to go to the moon. You should buy it, and also the crazy mess. You're like, oh yeah, I'm going to sign up for that. You hadn't done any homework, or you listen to your friend Bob down the street that doesn't know his ass from a hole in the ground. Says, oh, Jaden, you should buy XYZ stock. Well, why would I buy that? Tell me. Oh, I don't know. I just heard it from Sam over here. Oh my gosh, no. So you got sheep and you got pigs. People are just greedy. You're up 50% on the stock, but you still haven't taken the money, unless there's really a good reason why you haven't taken the money. And then, people who are really super greedy and they don't have the right skill set, they usually get their heads chopped off because they're greedy. And then by the time they figure it out, they usually sell at the wrong times and it's a bit of a problem. So you got to know what you're doing, and that's why you're here. And it takes time to learn. Told you guys before, if you think you're going to learn it all in 3 months, you're going to be sadly mistaken. I've got folks that have been with me almost a year and they're still making some mistakes, but they're making money. But we had one guy who made a huge mistake the other day. He's made a lot of money, thousands and thousands and thousands of dollars listening to me, because I'll usually say, here's what you should do. But then he got super aggressive and super greedy. He bought a stock that I didn't recommend. It was a crap stock. He put all of his money in one basket. And guess what happened to that basket? He was in traffic in Charlotte, in the Concord area. He knew he was trying to watch it. He couldn't get out of it in time, and the stock crashed from like $7 all the way down under $1. He lost all of his money that he had gained and then some. So he's starting over. He's learned a serious lesson, and I'll try to teach you every single lesson that I have learned to keep you guys safe. All right, let's finish up. We're going to talk about the difference between investors and traders. Traders, there's 4 types of traders usually. There's scalpers, people who are in the market in a particular stock and they're taking little bits and pieces of the gain. You know, the stock may go from $5 even to $5.05, you know, and maybe they're making 1%, but they're taking the 1%. And, you know, and they're taking the 2%, 1%. They're scalping, they're skimming. There are people who day trade where they pretty much close out their trades every day. Then there are people who position trade where they take a position in a stock. They might be in that stock for a few days or a few weeks, and then they're kind of out of it. They're believing the stock is going to do whatever they believe it's going to do, go up. So they take a position. You know, positions can last a little longer. And then you certainly have long-term traders, people that are in stocks for years, and they take big positions or they take positions over time, and they position trade. It's almost kind of like what people do in their 401k. They dollar cost average in, right? They buy shares of a mutual fund every 2 weeks when they get paid, and they're working for whatever, General Electric, and they just keep buying shares within their 401k, and they're long-term investors. And they're usually not moving money around too much within their 401k and their mutual funds. Kind of like that. So, you know, reading the difference between investors and traders, a lot of people think they're the same when certainly they are not. They both use the stock market, but they play different games. Investors think long term. They buy quality companies or funds, which I mentioned. They hold them for years, decades sometimes. They build wealth slowly through growth and compounding. Investors focus on company fundamentals, strength, trends, et cetera, et cetera. Traders, they think shorter term, which I just went over. They buy and sell more frequently, aiming to profit from price movements. Their goal is to take advantage of opportunities, days, weeks, months at a time. That's what I just went over. Traders focus on charts, timing, technical analysis, risk control, emotions, and disciplines. Which one is better? Neither. They're just different tools. Many people actually do a blend of it, and I would encourage you to do so, which I'm sure you will, because if you're working for a company, you typically have an opportunity to have money in your 401k, which allows you to put money away pre-tax. And if you got some good sense, you're also doing individual stocks and other things outside of your 401k. So it's all about, what your goals are, what your plan is, but it's important for you to learn about your money. So we're not going to do any more today. I'm going to stop this recording. Hold on one second.